Yo, what is up, guys? So, I might not have time to finish this video if my sound mix up, but I'll just do a little edit and clip it real quick. So, we have this video is going to be over how to use COT data. So this will change your trading very, very majorly. You'll be able to see how this all works right here. The only thing we're going to be focusing on is these two graphs and then these two tables, and then we're going to go to the chart and see how it applies, right? Real quick. Okay, so when you're looking for COT flip, it's basically this is exactly where the institutions are doing week by week, right? So every week, you can see the weeks going by. You have this is the month right here. So they do month and then day and then year. So you have March to April COT report, and you can see they went from negative 1.5 to 0.9, showing that they're pushing long positions into the euro. So you can see right here, the only thing we're going to focus on in this area before I even get too far ahead of myself is net percent, long and short, as well as the date. That's literally it. And then we're also going to be paying attention to these graphs, right? So when you're looking for a COT data flip, you're essentially looking for institutions to be trading against the retailers, or I guess you can think of it as retailers trading against institutions and what they're currently doing, right? You will be comparing this to seasonality as well. And the reason why is seasonality is pretty important. Right? Currently, let me let that load a little bit. You have an overall bullish seasonality, right? But there's bearish phases, as you can see within the seasonality. You can see right here on the right as well that it's dropping out into the negative, the seasonality, and then it's going to go back positive, essentially, is what they're predicting in the future. Overall positive with the bearish phase right now. And the reason why we're at a bearish phase, and then also this time, last year was also bearish, which lines up with last year's seasonality as well. So got bearish predicted candles and everything, fluid all the way through the week, which is why I sold this today. And then we have, of course, retailers. They are 60% long. I do expect them to flip positions based on the COT data. Sometimes retailers will flip back and forth because they're indecisive. And yeah, so they tend to be very indecisive. I've seen this happen before. So essentially, they were long, now they're net short. Then banks are likely gonna, within the next 24 hours or so, convince them to go net long, with a little bit of manipulation on the way down. So typically, that's pretty much how that works. We have the actual COT report after that, right? And essentially, what you're looking for is you're looking for basically banks to be trading in the direction that they intend on trading, right? If you see right here that the zero right here is going to be the equilibrium, it's going to be the 50%. Anything above that's going to be like 2, 4, 6, 8, 10, right? And then obviously below zero is going to be -2, -4, -6 right here, -8, -10, -12, etc. Right? So the zero is the equilibrium. Anything above zero is going to be positive lots. As you can see right here, this phase right here, this was when they were net long, net positive 1.1 lots, which means they were in the buy phase, and you can see how the green reflects there, right? And then just now this week from last week, right? Because it was 412. If you look right here, this is 412, right? So that was this at this point right here on April 12th. This was April 12th. At the time, they were positive 1.1%. All right, the flip would be too negative, because if you think about the fundamental aspect of this for the economy, with the war going on in Ukraine and inflation at a record high and all that, the euro is currently falling pretty hard and has been. So is the Great British Pound, really. But the Great British Pounds, they haven't went net short on the Great British Pound. And I'll show you an example of that as well. So you have 412, which is April 12th. That matches up with last week's COT report. This does release every week. So you can literally see over time, right? If you look at the net percent, them adding or taking away lots, right? So they basically they started adding more positive lots. You can see right here on the graph, it says -10.4, then went negative, you know what I mean? They slowly started adding a lot more long lots, and this was a phase of manipulation, right? And over time, all the way until they got net positive, and then they suddenly went back negative, which is this week from last week, 12.4, 12.4. And then this week's going to be 4.19, 4.19. From 12.4 to 4.19, we had a COT data flip from net positive to net negative. The European economy is suffering, so that's a sign that banks are getting ready, right, from the equilibrium to go back net negative and add a lot more bearish lot with the retailers mostly long on this pair. Not currently as we're looking, but like when I looked at the time I was doing my analysis, they were net long. They do, like I said, they tend to flip back and forth. But I'm basing my trading off of the actual banks going net negative, showing that on the euro, they're getting ready to drop a bunch of continuously bearish lots over the next several weeks. And we'll watch this, obviously. If next week's negative, negative 10 from negative 0.7, there's more evidence right there that they're going to continue to sell. Now you take price and you do the same thing. You continue to sell. I don't want to catch the entire move, right? But I want to catch 15% gain on this short move from 392 pips, maybe 2 entries. And that's how I kind of structure my trading when I'm intraday trading or when I'm swing trading from a Monday through Friday basis. I have to trade less and I go for larger RRs a lot of the times. So that's how that works, right? You're looking for the dominant pair, which would just in this case would be the euro, to flip to your desired direction before you even think about entering. So now I know, right? And now I know with the bear candles and everything, exactly where the institutions are going to be selling from. The high of this first bearish candle today was 0.84, 202. I always go off the high because I want that rejection to happen in that area. And then I look for evidence that it's going to continue to sell from there. So 0.84, 202, I believe it was. And then you go here and basically you could do it this way as well. You can mark off 12.4 on the COT data if you want to kind of have a reference for an area. Get in there, bro. Give it a second to load. Perfect. You can do 12/4/2022. So let's go like 12/4. So that'd be April 12th. Zoom out a little bit, get a little bit of leeway. April 12th, and we'll just do the turnover right at midnight. We're gonna grab our tool here. We'll do the turnover right at midnight. Come on, give me it. Right about there. So that's April 12th. That was last week's positions when they were net long, right? And we're gonna turn off some of these real quick. Not necessary. So they were net long, basically from on 12/4, and we marked off 12/4. Now we're gonna go 12/19 and do the same thing. And this is just a way I kind of have an area of reference for like where the banks are, buying and selling from. The 19, we're gonna go try hit that right at that midnight mark when it just actually physically turns to the 19th. All right. So that means all the price action, right, given this from the 19th on is going to be likely, well, it is going to be 100% the banks likely just driving price into taking buy side liquidity and then driving price into an institutional footprint such as this daily order block that I found within my analysis. So I did from the daily down, there was a daily order block, and then I went down to, I believe the H1, and there was the H1 order block right here. And I just kind of marked that up for reference in case the price did react to it. And zone was at a premium, So that's another great sign. And I waited for, I put my fib on the 50% of this candle right here, and I did set a limit order. There was a little bit of drawdown of like 10 pips or maybe 14 pips. And then the price ended up falling from there after creating another institutional footprint, another shift in liquidity, et cetera. I got more confirmation that this was continuing. So which is why I wasn't worried about it. And now price is continuing to sell while printing more institutional footprints for a profit for a trade for 380 something pips. So not bad. I had a small amount of drawdown. I would like 0.3, 0.4% drawdown or something like that. 0.4% drawdown or something like that, but not terrible. Like I said, the goal is to be effective and not perfect. And this was a 30-minute time frame entry. Pretty good. I would say if I were to improve something on this trade, I would wait until they cleared the buy side liquidity and then create a more institutional footprint. Sometimes this does happen on certain pairs, like Euro and Great British Pound. They kind of move a little more weird than your average euro pair because they're both kind of in the same area, and the same regions, typically. So they kind of react off of each other's news a little bit more weird than each other's world events because they share similar world events, and how it affects their economies as well. So we got to drop down here, and yeah, this is 392 pips, and you can station that for like 1 or 2 entries, and using the scaling method that I showed you in Fibonacci confluence. Obviously, after it takes sell side liquidity in any regard on the way down, you're going to consider that like um, a way to gauge retracements. And once you have really big retracements back up, very exaggerated ones, you can pull out your fib from the impulse move and kind of build some confluence with like fair value gaps on your entry time frame, looking on your higher time frame to see if it's filling any fair value gaps or anything like that currently at the moment, and then using that as well if you have that. Otherwise, you can gauge it on your you can gauge it on your entry time frame as well pretty easily with just fib confluence and basic understanding of the fact that they have to take sell side liquidity, and once they do that, they have to come up and shoot up for buy side liquidity, and that's how the algorithm operates. So you can expect retracements to be opportunities whenever they come for buy side liquidity in the short. That's could be an opportunity to get another entry if the push to grab the buy side liquidity is large enough. It's definitely going to be an opportunity to actually get entries, get better entries. So and get secondary entries at that, maybe even third entries, very precisely based on liquidity and it driving itself into another bearish order block or another bearish fair value gap. You know what I mean? So once you do see stuff like that, you'll see like price impulse leg down, that maybe it takes all of this liquidity on the sell side, and then around this area, it starts to retrace very heavily. I'm going to look for it to take some buy side liquidity, and then the retracement is going to land inside some type of bearish institutional footprint given the COT data. So this is a way to kind of gauge that. This is, like I said, April 12th to April 19th. So you literally have, if you go to the daily time frame and show the same markups, like in terms of the actual portions that these here lines, the vertical lines that I drew for the dates that the COT data flip happened, you can see right here on the way to April 12th, you can see there was a bearish order block here, and that's an institutional footprint. And right here in this crosshair, the recent buy side liquidity was taken. So really, if you had some knowledge of her value gaps, you could have easily gotten in way earlier than anybody else. But there's a secondary bearish order block created, and this is what they currently are mitigating, obviously for the short. So we just had that rejection of the equilibrium, and now we're going down and continuing down on that. So I counted on that because there was a prime market terminal predicted level right here, which lines up with the institutional order block and everything. So you have all this time, basically, this is just the beginning of the sell for the banks on the COT flip, So I have all this time right here to get in. Price action will likely hang out around here for maybe a few more days, and then continue to drop very hard, given the COT flip. So that gives you kind of an area of reference from the 19th on to the right. You have time to get into this trade. They normally manipulate just a little bit, but as long as you follow your trading plan, you should be able to avoid that manipulation. So yeah, this is going to be a solid trade. We'll see how she goes. Like I said, anything is possible. I could lose on this trade for sure, and we'll go from there. So like all euro pairs are like that. I want you to kind of have a realization here. So look at the euro. You can see it went from net long to net short within the last week. That's a COT flip right there. If I'm looking for a buy, I would be looking for a net short to net long COT flip, and then that'd be an opportunity. That's basically a time, showing you a time when the banks are dispersing their actual orders and where they want to go, and that's an opportunity for you to get in on some very high volume, high momentum trades, catching hundreds and hundreds of pips, because when the banks push their orders, it's what creates the volume in the actual market and things like that. Also, the algorithm works too, so it's like basically trained to stop hunts and things like that, and it's AI, and that's how it's so intelligent. So believe it or not, I'm showing you guys optimal proof of the algorithm. And real quick, that's your Great British Pound. And let's look at another one real quick. Euro New Zealand dollar is going to be another one, that contender of mine that I'm looking at doing some big swings this week with, kind of a more intraday style. So it might be like kind of more like medium term, just like the Euro Great British Pound, but I might hold it for a week given the COT flip data, right? So this is the same story, you know what I mean? Seasonality, you gotta check that. You have other confirmations as well you can use, but I'm not going to cover that today because it's about COT flip data. Last year we were bullish, seasonality was, but currently we are bearish. This is in a bullish phase right now, right? This is kind of in a bullish phase. This is current seasonality and where it's going. But if you look at pattern scan, right? Pattern scan has some bearish predictive candles. Well, why is that? It's because 65% of retailers are long. They're going to trade against the retailers, right? So are you. Then you go to the COT flip data, right? And look at this. This is euro versus the Australian dollar. The European economy is suffering, and so is really the New Zealand economy. But we're going to focus on the dominant pair. It'll always be the dominant pair. You look for the flip to happen, just to let you know. With the dominant currency, which would be the euro in this case again. So this is just euro paired with another country, right? Both of them are net negative right now overall. You can see this is net negative, but they're currently from the last week, right? This is 412 again on the New Zealand dollar. They're going from negative 14 to positive, or my bad, from negative 14 to negative 2, which means they're showing that they've added a ton of positive bullish lots in that regard. So, and you can also see the percent gains. I forgot to actually cover this as well in the earlier example. You can see here they went from 51% short to only 43, but they added a bullish lots right here. They went from 36% long to 41, showing that they added bullish lots, kind of matching up with what's going on here. Going from negative 14 to negative 2. The reason that happened is because they recently added a bunch of bullish lots right here from 36% to long to 41% long on the dollar. So they're basically adding bullish lots to this while adding negative lots to this week on the euro once again. And we look for the dominant currency here. It went from net positives to net short. So currently the euro is falling. Banks or institutions are investing in the short for the euro in order to make money and capitalize on the current falling economy based on fundamentals, right? You know, higher on the research tab, if you have probably like a terminal and you have this version of it already, you know, how are investors feeling, right? Match that up with what institutions are doing. This is showing you what bank and institutions are doing, and then you match that up with things like hot data. Like I sent you guys hella research reports to show you kind of like my own personal research that I do on all of my trades and how I put it together. Every single last one of my trades I take is documented to the T, right? It takes me 15 minutes per PDF maybe, you know, so if I'm only working with 3 pairs like I am this week, I'm only working with 3 pairs all week based on my COT flip data and stuff like that I've been waiting on. I'm going to capitalize on that all week, you know what I mean? 1-2 entries per pair, and then you're done. That's a lot of gain right there, ton of gain. You only have to be correct once. And then when you scale it, you can scale it and maybe a higher lot size on your second entry because you already know you're correct on the trade, you're correct on direction. You know what I mean? Maybe you remove your risk from your first entry, right? And then your second entry, higher lot size, a little bit of a higher lot size. I wouldn't say be too generous, but on my personal account, I tend to scale on like that. 5% risk on my first entry, and then if I'm getting a secondary entry, I already know I'm correct on the trade, so why not scaling? So 1.1% to negative 0.7. I mean, yeah, negative 0.7 is showing a COT flip from net long to net short. And like I said, given the other fundamentals and things in place, just this alone right here is really good. But when you pair this, because it's just showing you literally what institutions and investors are doing, the big boy players, you know what I mean? And you can take the moves when they're taking the moves too. Like I said, you always do the dominant pair. So now this is a great opportunity for anybody who's swing trading to swing trade this, because now that they've met the equilibrium up here, they went a little bit net positive, and then now they're flipped to net negative. They're going to continue to come down and go very deep into net negative, and it's going to create a lot of volume and volatility in the market and on the euro. Any euro dominant pairs that are going to be shorting. So this is an opportunity to go long term. You can do medium term, and like I'm doing, do 300 some pips per entry. Going for larger RRs and 15 to 1 to 2. So I'll be getting 15.2%, possibly 30% on this trade if I end up getting the second entry and it goes well. So obviously we're going to be taking profit off the table at certain points. I Fibonacci tool here, I'm going to be taking profit off the table once it goes deeper into discount territory and things like that, and I get my confirmations. We're gonna get destroyed. Okay. So here's another example real quick. Same thing. I'm gonna go to here real quick, and then we're going to go with another pair that I'm looking at that I have a limit order for. Let's go Euro CAD real quick. I'm just gonna show you something similar, and this is how you can capitalize off of COT flip data. You can trade similar pairs that are all doing the same thing and be 3 for 3 or 4 for 4. You know what I mean? For um, really big moves that the institutions are making. And why wouldn't you, based on what I taught you, why wouldn't you make them with them? You have to make the moves with the institution and think like them. You're not taking an institutional move. You're going to stop by retailers with those institutions. That's how I think of it when I trade. I'm like, I wake up in the morning, I'm like, damn, how many retailers am I going to stop out today? Even though I know like my putting in my order is not going to move the markets at all. Like it's a mindset thing. I think about like, yeah, I am with the banks. I have Carmichael Terminal. I have the knowledge of being a spot liquidity and things like that, and avoiding exactly what retail traders commonly struggle with, and it's getting stopped out all the time because you have knowledge of the markets, right, and institutions and liquidity and how that market really works, and you pair that with COD data and things like that. It's really powerful. You can really like murder the market in a way that no one's ever seen before. It's very possible. There's a trader right now, the old trader, institutional trader, right, old guy, right. His strategy allows him to bring in 60% a month consistently. Or no, my bad, not bad. That's an insult. 200% a month consistently. Can't remember his name though, but it's 200% a month consistently every month. I think he holds the Guinness World Record for most consistent return. I'm looking to beat that. So you have same thing. Euro CAD is another pair. Euro COT flip data. You can see they're going to net positive on the Canadian dollar overall, and the euro is net negative, showing that the euro is falling to the Canadian dollar. You can see the COT flip positions right here happening. It's the same thing. You can do the same markup. So Euro CAD is one that I have for a limit order based on change of structure, bearish liquidity shift, and things like that. They do have the London Open marked up. I do expect them to, because they already took this buy side liquidity right here to hit my 62, but I do expect them to come up for a bit more and basically trade above that London Open to my M30 bearish order block that was created that caused the what is it called? Caused the I can't think right now. Caused the bearish liquidity shift. There you go. Couldn't think for a moment there. So you can see right here that in this area that price started to break down, the bearish order block created, and basically this is where the bearish liquidity shift happened for me because it traded below a candle swing low. If you wanted to be a little bit more thorough and back test, you could take maybe the next one, which would be responsible for that, but I did mark up that London Open as well for a little bit more confidence. So that's why I was expecting them to basically trade back into here, because the London Open has not been traded yet. And if not, worst case scenario, I bust out another tonight's London Open and wake up in the morning, and that's that. You know what I mean? Get an entry that way as well. So there's multiple opportunities for the next are shorting. Another one, same thing. Your New Zealand dollar, I just showed you that. I had a 30-minute order block created a big bearish liquidity shift, and they created some buy side liquidity right here. I'm expecting them to come up in the house like Fibonacci confidence, since it's inside of my daily order block or fair value gap. So yeah, that's how you use COT flip data. Whenever your retailers are one way, you look for banks to be flipping to the other way. So red bearish pound pairs are going to be not ready yet, but they're heading that way, and you can tell. You can look in the weeks to come to see, but it's the same thing for gray bearish pound pairs. They're getting ready to fall too, but it might be 2 to 4 weeks before they actually drop. Sometimes they do big jumps from like positive 9.3 to negative 10 out of nowhere, and then that's obviously a massive sign to short gray bearish pound pairs because they're suffering the same fate. Same thing for 12 to 419. Currently, they did go very much so net negative right here, and then they started adding bullish lots from basically 12/21 Christmas last year, just about Christmas last year to now, and now you can see for the graph is actually going down currently over here, but you can see over the previous weeks they were at net positive 11, positive 12, and then they dropped to they were positive 12.9, and that was pretty steady for that. You know what I mean? They were from 3% to positive 11, showing from 322 to 329, and then they went from positive 11.9 to positive 12.9, showing that within a week's range, they're adding more bullish lots. So you wait, because I am expecting the Great British Pound to fall, right? Because given all of the things that I just showed you. And then they went from 12.9 to 11.6. Okay, it's a sign of them pushing bearish lots. And then they went from 11.6 to 9.3, pushing more bearish lots. So this is making me think that institutions currently, as we speak, are going to be pushing below this equilibrium right here and going into net negative for the Great British Pound in the coming weeks. So if they continue to, and this is something that you can literally prepare for and watch over the weeks. So you can go, okay, this week is negative 9.3 from negative 11. That's the sign, and keep watching, right? And then next week comes, and then it's negative, positive 3.2 or something like that. Ooh, that's a big change, right? And then the next week is positive 1%, right? Okay, that's another significant change. You're literally watching the trade unfold in institutions over the weeks, changing their positions as expected based on your fundamental research and things like that. And obviously your technicals too. And then where retailers are going, and pattern scan as well. If pattern scan is bearish, why is it bearish? This is because retailers are long, right? And that would require, and like I wouldn't sell this until they went negative on the Great British Pound. So it's going to drop over the next weeks. Who knows? It could go from 9.3 to -1. And that's it. Yeah, that's a big data COT flip, and now you're looking to short the euro. The Great British Pound and other Great British Pound pairs as well that are paired with the Great British Pound, because you're going to always look at the most dominant pair in the two, in which in this case, the Great British Pound. So that's exactly what I'll be doing over the next weeks, is going to be preparing for that. I'm going to be preparing for my big Great British Pound swings, and or like kind of medium term swings for like intraday-ish action, like I'm showing you right here on these pairs. I would consider these swings just because it's going to likely take about a week and a half for them to all smash TP, being realistic. But who knows? It might surprise me some volume and volatility. So you have that happening, and I believe based on this graph and based on the fact that they went very deep net positive in recent time, they're going to continue. And you can see the evidence here to go net negative, pushing more negative lots and bearish lots into the Great British Pound for the last 2 to 3 weeks up until this week, which is the COT reports we released on the 4/19. So if next week, what do you think I'm looking for? Net negative, more net negative, more net negative. And then I'll watch the graph just moving over the weeks down, 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 down. Once it gets to equilibrium, it's going to be very interesting, because then the next week after that, if it's not already pushing down to net negative, if I don't already have the COT flip, then I'll have the week after that. And I know that week I'm going to be just destroying all Great British Pound pairs. And this is how you use COT flip data. You wait for the banks to show their hand in terms of data, literally what they are doing. This is public information. It's just compiled into something that you can actually read and understand. So, but once again, you're going to be using net percent in the way I just showed you. You're going to be using the graph and the numbers here in the way I just showed you. And you're going to be using the dates, the way I just showed you as well. And make sure that you're also looking at this, so you can see the evidence of that too. These match these data over here, right, from week to week as well. So you can see here, they went from short positions. You can see they went from 13.60% to 15.70%. They added short positions. The long lots, wasn't much change. They went from 25.20 to just 25, which means they took away long lots. They added a significant amount more of short lots, and then that reflects here. And then that also reflects here in actual lots. And then you can compare the dates and look, and you can see the evidence. Like, yes, on the Great British Pound, they are selling it. This matches up with fundamentals. When with how investors feel, we're going to continue to watch this and see which week they are going net negative. So this is something that I'll be watching for the next several weeks. And once I have that, I think I'm going to make a video, because I'm going to enter some very massive swing trades, like on Great British Pound New Zealand dollar, for example. That could be 1,000 pip swing trading because of how volatile the pair is, right? So that being said, that's how you use COT flip data. That's one of the confirmations for my strategy. I typically don't even touch a pair unless I have institutions doing a COT flip in the direction that I am anticipating it going. And I anticipate that based on fundamentals, how investors are feeling in the research tab. Retailers, like for example, Great British Pound and Euro pairs have been net long for retailers have been net long for quite some time. So given the war and everything like that affecting the economies, inflation rates, freaking Russian gas exports being cut off potentially, and a lot of Europe depends on Russian gas and Russian oil and stuff like that for that, and they're that's resulting in the gas prices spiking. I mean, their economy is suffering, so that's just feeling short on a Great British Pound and the euro based on that, right? Fundamentals actually matter too. So this is stuff you can read, and you can spend maybe 30 minutes to an hour reading like reports. And I usually read 3 or 4 about the pairs that I like to trade, and 3 to 4, sometimes eight, and I'll get the overall. And look, all the investors are feeling short. If I looked there, I read all these reports, and they're all feeling short. So now you're gonna look for evidence of that and expect that to happen, and then make sure retailers are still on par as well with being the opposite of what the banks are doing. You compare that to seasonality, right? The reason why they're selling when seasonality, if I remember right, was long currently is because retailers are long with seasonality. This is the seasonality is the bank, the way that banks actually intend to go for long term. And if retailers are long, it's not profitable for them. So they have to sell, explaining that. Also, you pair that with fundamentals in the research tab for the research tab for things like I don't know. So these are actually more they show you the tag, they tag, and they show you which pairs have to do with it and how investors are feeling, how's the euro performing, et cetera, et cetera. A lot of things are going into this, and you have to read and understand the fundamental side of things too, because fundamentals really move the market. So that being said, that's how you use COT flip data. Pretty easy. Stuff. 94% of retailers are long on this pair, and they've been long for a long time. So that's why I'm looking at this big influx of buy positions recently. And this is why, I think that pretty much know that they're flipping positions currently, because they've been selling and adding a lot more lot positions for the last several weeks, as I just showed, and I showed you how to use everything here. Always look at the most dominant pair. The fact that this is net negative and it's been net negative is a good sign as well. It can be net negative. The non-dominant pair could be net negative, as you can see right here on the USD from March 1st, 2022 until today. They started adding negative lots from that point on, and this is essentially what I'm looking for to happen on the Great British Pound. In the coming weeks, you can see how they kind of look similar. I'm looking for this to happen. Once I get that first turnover, like this went from a positive 11.5, if you look here on the right, to negative 9.7 in 1 week. Shit can get escalated real quick. So that would have been a point on any USD pairs, right? USD dominant pairs, I would have sold that, because this is consistent. So you can see it on the graph. You can literally see it happen. You can see the USD pairs continuing to go more and more net negative as time goes on the week. So you can look at USD dominant pairs with this data and be like, bet I'm gonna sell it. Once if like that's easy, bro. That's really easy. You can really just do this all day long, and then you can mark up how it shows you, and then you can know from the current date where the data flip happened on. You're gonna have a little bit of time to be able to get in to that actual position to catch a very nice swing. You can catch pretty much as many pips as you want to, because long term they're going to be shorting the pair against these retailers. So you know that over the weeks, if you're like long term hold and kind of grow your account in massive chunks, that's the benefit of that for me at least. You're going to be comfortable holding that and manage the trade, dropping stops at break even, taking some profit off the table, adding newer positions. If they continue week after week to add more negative positions and you can see it, that's more confirmation to keep on shorting, keep on adding positions, right? Once you kind of see evidence of them going more net positive and it's consistent over some time, you can be like, okay, maybe it's time to close off positions, and then you can go compare some fundamentals to see what happens news-wise that made that happen, you know what I mean? And then kind of adjust from there, you know what I mean? You can use this as an opportunity to hedge. You can see when the banks are hedging themselves, if they're all net short, right? Anything that's bullish is going to be a manipulation. But I would have used this area to hedge for longs, and then when you're more experienced, you can do this, and then way back negative, then you can add more short positions and such. So you're making money on both sides based on what institutions are doing, what I just showed you. So that's a little bit more advanced. I might drop a video on that, but it makes it really easy because you can literally see like, yep, they're over the last couple of weeks adding net longs, and then once we get a COT flip to net long, you can buy, buy back your sell. That's what they call it, and then you can have two positions running in profit for your long-term sell and then your short-term buy. As long as they're net positive, adding more positive positions, you can hold that hedge. Once you see them dropping back to net negative over time, you can close your bought long positions and then get ready to add another long position or short position for the overall trend once we get another COT data flip. You see what I mean? You can go crazy, and then long term have a lot of trades running. Medium term, secure a whole week's worth of profits in a few trades with just a bigger move. Makes it really easy. I see you guys later.